Hi everyone. Let's attempt to simplify a very complex topic: how to evaluate businesses during divorce. There are three methods: market, income, and asset. However, before we go there, we have to establish whether the business is community or separate. So an example: Mark opened a bakery 5 years before the marriage, and then at the date of the marriage, he was going to the bakery every day and helping to grow the business. Then in valuation method, the increase in value from the date of marriage until the closest date to trial is attributed to his contribution to the bakery. If his wife went to the bakery, if he went to the bakery, if he put any personal effort or community money into the bakery, then the increase in value is community. Now, it could be a bakery, it could be professional practice, massage, truck business, moving business, any business. So now the timing is, it has to be contributed during the marriage. Second, the methods of how to divide it. Buyout, meaning pay the spouse who is not going to keep the business out of the business, meaning a lump sum. Sell the business and give the percentage that spouse gets out of the community, which is half of the community, or agree to co-ownership, which is the most difficult one. Let's say you have a restaurant, you don't want to sell it, and you don't want to buy out because there is not enough cash, then the spouse can co-own and work in the business. I'm mostly going to talk about buyout because that's the most common way of doing it. So let's talk about the first valuation method, market. Market means we look at, has a similar business been sold? How much did the buyer pay? If there is not available, what are the trends? What are businesses on the market valued that are similar to this business? If that's not available, looking at income, future profit of the business. Let's say a professional corporation, massage therapist office, any business makes $200,000 profit a year. Then divided by 0.25 will be 800,000. So then the business value is 800,000 and the spouse gets 400,000. So profit a year, or average of last 3 years, divided by 0.25. Then we could have another situation of asset method. Or let's say we have a truck company. We look at the tangible assets minus liabilities. It could be future tax liabilities, future predictable cost, value of the trucks minus the predictable cost equals value of the business. Factors that we consider: ownership. For example, a spouse could have only 25% ownership in the whole business, then the other spouse gets half of 25. Brand reputation. So we are going into not so tangible ownership called goodwill. What is goodwill? Goodwill is reputation attributed to the business brand, not the owner. So for example, if we have a medical practice and we say it's worth $2 million and we use different methods to establish the value, but $300,000 out of $2 million is attributed to the owner of the practice. So meaning the people didn't come for the brand, they came to the owner, then we deducted from the total amount. So 2 million minus whatever was attributed to the person itself. That is not goodwill. The court is not allowed to consider personal reputation for the purposes of goodwill. Goodwill is only branding, location, not personal. Then the business would be 1.7. Timing. Oh, one more thing. Manufacturing companies. So for some companies, it could be used 2 methods or 3 methods, and then we use the average. For example, we use income method 2 million, asset method 1.8 million, then most likely the forensic accountant would say that the business is worth somewhere in the middle, 1.9 million. Timing. The timing for evaluation of the business is closest to the trial date. However, if after date of separation, the increase in value, let's say we have a software company that was valued at date of separation 1.9 and grew because of the improvements post-separation to 500,000 more, the community doesn't get the improvement piece of it because post-separation efforts are attributed to the spouse who put efforts into that asset. Overall, I think evaluating business is one of the toughest, and the court has a lot of discretion. Of course, the court has to follow the cases of appeal and methods, but there is still a lot of room for discretion. I would suggest to hire a forensic accountant and look at different methods and different case law related to this particular industry to evaluate the business. So I hope that was helpful. Like, subscribe, and I will see you in my next consultation. Bye.